Hey, welcome everyone to my Celeste Barr real estate channel. Tonight I am interviewing Josh Hartman. He is with Loan Depot, and Josh and I have known each other for, I would say, what, 3 years?
No,
Year and a half, three. It seems like 3 years. Just
seems much
kidding.
longer, but we work together a lot, so it's
Yes.
understandable.
Yes. And if everybody, you should know this by now, but I'll just introduce myself real quick. I'm a realtor with eXp Realty. I have been in the business for 35 years, helping buyers and sellers either sell or buy a home. And throughout the years, I have vetted great people to work with, whether it's an inspector or an attorney, or in this case, a loan officer. And the reason why we're even having this meeting is because I value Josh and his experience. So I am going to ask Josh if you would do me just a quick favor and kind of give me a synopsis for our audience as to who you are, how long you've been in the business, and maybe your philosophy on this process, in the process.
Sure. Absolutely. Thank you, Celeste. And first off, I want to just thank you for your partnership. It's just so great to be able to help so many people with their, buying their first house, buying their second house, upsizing, downsizing. I really value your partnership, and big part of that is because I know that just like myself, when it comes to our clients, you're going to go the extra mile. You're going to do everything you can to make sure that they're properly taken care of. So, your partnership is just as important to me as mine is to yours, I hope. So, yeah, I mean, thank you for that. A little bit about me. First off, my disclaimer, I've got to give my NMLS ID. It's 215294. I work with Loan Depot. I have been helping people with their home loans for 25 years now. I'm 45. I started when I was 19. So either I can help people with their home loans or I can work at the hardware store. Those are kind of my two career opportunities that I have available. So some days I'd like to be at the hardware store, but I love what we're able to do here for our customers. It really does feel like I'm making an impact in people's lives every day. So, like I said, 25 years in the business. I've worked for gigantic banks. I've worked for small mortgage brokers. I've kind of done a little bit of everything in the mortgage industry. And anytime that I've tried to explore something new, I always end up right back into a sales role, right? And the reason that I love this so much is because I'm the first person that people typically talk to when they make the decision that they want to buy a house. Everybody knows the most important thing you can do is talk to a loan officer, talk to somebody who knows how to work the financing, because the financing and the agent that you choose truly are going to make the difference on whether or not you're able to buy that house or not. So just some of the things that I love about this. And I don't want to spend too much time talking about myself, but do want to make sure that I share my experience with you.
So I will bring that around and say to everyone who is watching, one of the things that I want you not to worry about is taking notes. In the description of this video, we will have Josh Hartman's full information, his phone number, his email, his company, so that way you can reach out to him directly after the session. I will have my information, of course, but I want to focus on tonight's meeting. This video is all about you, the consumer, and how Josh can help you through this process. So in advance of our session tonight, I had asked Josh to help me and get some questions together, which are the typical questions that most buyers might ask when they're looking for a loan. And I guarantee you, one of the things that I want to start with is no matter who you are, no matter how many homes you've purchased, the questions are often the same. People start with the basics. Am I qualified? How do I know I'm qualified? What do I need to bring? All these things. Josh is there to help you from the moment you start till the day you go to closing. And with that, these questions that I have asked that he proposed to us, I'm going to start with this. Ready?
Right.
What do you think is going to happen with interest rates?
Yeah. But you know what? That would be a really good one for us to talk over, because whenever I speak to somebody the first time, whether doesn't matter what their experience level is that is the hot topic of the day. And I think that before I get started too far into it, I just want to kind of clarify and sort of do a comparison and contrast to where we are now compared to where we were, say, 4 years ago. Okay. So we all know that the interest rates basically dropped to basically nothing when COVID started. And a big reason for that is because the government was printing money. They were using that money to buy up bonds and mortgage-backed securities. So what will happen is they go out and they buy a bunch of 10-year treasury notes. Well, it's supply and demand. If there's a huge demand for 10-year treasury notes, that's going to push the price of mortgage rates down. Well, what's happened after the last 4 years with the inflation that we've seen starting in 2021, it really started, rather 2021, it really started to take off for us. Essentially what happened at that time was we had a brand new administration come in, and the Federal Reserve took a look at their balance sheet and said, hey, it looks like we're starting to come out of this whole COVID problem. What we are going to do is we're going to stop buying up these mortgage-backed securities. Couple that with the fact that we had just a ton of government spending in response to COVID, it was natural for inflation to start to take off. And we all remember what happened. The inflation started to rise like crazy. The cost of everything went up. And our government told us that it was going to be transitory. They were not truthful with us when they said that in any way, shape, or form. And I knew it at the time. So what has happened is the Federal Reserve made the decision that they were going to have to increase the cost of borrowing for lenders and for banks. Now, this is where it gets a little bit tricky. That doesn't directly impact mortgage rates. Mortgage rates move in anticipation of what the Federal Reserve is going to be doing. So our mortgage rates had already started going up, and the Federal Reserve, and this is 4 years ago, 3 or 4 years ago, the Federal Reserve said, all right, we're going to have to raise these interest rates and make it more expensive for everybody's credit cards, home equity line of credits, car loans, business loans, you name it. Well, the mortgage rates had already been moving up in anticipation with that, and they still continued to climb. We actually hit our peak about this time last year in August. Yeah, it was about August of last year. The average interest rate for a 30-year fixed mortgage hit about 8.25. And I remember that day very well. Shortly after that, end of the year, we started to see that inflation was starting to get under control. There's three main reports that we follow: the Producers Price Index, Consumer Price Index, Personal Consumption Expenditures. Those are the three inflation reports that come out at separate times each month. Every time they come out, the readings are a market mover. Well, we had increases, interest rates rose and tracked with those reports. And then they started to get better. And the reason that they started to get better is because the Federal Reserve had kept the interest rates so high for so long that inflation started to come down. Now, that doesn't mean that things are necessarily getting cheaper for you and I, Celeste. What it means is that the increase in costs is slowing down. We still have costs going up, but they're going up at about a 2.5% rate. The Federal Reserve says that once we get that number down to 2%, they're going to feel a lot more comfortable with inflation. So what that means is that since we're already at about 2.5 right now, they're in no hurry whatsoever to start reducing their interest rates. Now, remember, the mortgage rates are going to change before the Federal Reserve makes the announcement to cut rates. We actually saw that this summer. We had a huge drop. And we had a huge drop in the summertime because we knew that the Federal Reserve was finally going to get to the point where they cut rates, which they did a couple months ago. We're expecting maybe another rate cut in December, maybe one or maybe two in 2025. Bottom line is there's really nothing that is suggesting to us that all of a sudden that mortgage rates are going to magically get better in 2025 because we have a new administration. That's not true. Doesn't matter because Trump's going to be in office. That doesn't change things. In fact, it may end up being inflationary depending on what happens with the tariffs. We don't know. So the Federal Reserve is kind of in a holding pattern right now where they're not in a hurry to do anything unless we start to see a major loss of jobs. Last jobs report that came out, it comes out on the first Friday of every month. Last jobs report that came out showed that the economy and the jobs were still doing very well. The prior month, we did have a poor jobs report, and a lot of that was simply just because of the hurricanes that we had in the Southeast. So I don't have a crystal ball. Anybody that does tell you that they have a crystal ball, run, don't walk. They don't know what they're talking about. The consensus is that we will probably see interest rates stay elevated for the remainder of the year. Which I think you might be able to share something, Celeste, on why that might not be a horrible thing and how what we're seeing with sellers and how they're kind of coming back down to earth when it comes to accepting offers and entertaining. But I'll kind of leave that up to you.
Okay, well, so far so good. Boy, that was an answer.
Yeah.
Wow.
But then
Wasn't
there's a little
really
bit more
sure I
to it.
was ready for that.
It's a little bit more to it, but I wanted to give enough to help somebody that felt like, hey, you know what, I need to do my own research. Now, when they go get to do their own research, they can say, oh man, I remember Josh talking about this, talking about that. Main things are jobs and inflation. As long as those two things are going relatively well, we can expect to see interest rates stay elevated for a period of time.
Okay, I'm going to ask you another question here. When it comes to getting a down payment, what are the most common questions you're getting about, not having enough money for the down payment?
Yeah, the number one question that I get is, do you have any first time buyer programs? And usually when people ask me if I have any first time buyer programs, really what they're asking me is can you help me with money for my down payment? Because I'm getting killed on rent, I'm getting killed on car, price of eggs, everything is so much, it's too hard for me to save. Yet at the same time, if I could get out of this high rent and into a lower mortgage, I'd be fine. But we keep having a catch-22 chicken before the egg scenario. So the good news is there's been lots of down payment assistance programs that have been around for a while. And the beauty is that you don't necessarily even need to be a first-time home buyer for a lot of these programs. So for example, here at Loan Depot, we have an FHA loan where we will do the loan for you. You don't need any money for a down payment. Typically, the requirement is that you have 3.5% down. However, given how many people that we help throughout the entire country, FHA has allowed us to offer a no money down FHA loan for first and second time buyers anywhere in the country. With FHA, we can also ask the seller to pay up to 6% of the sales price of the house towards your closing costs. So what that means for you, Celeste, we could go get you a $350,000 house. Normally, you'd probably need about $11,000-$12,000 for your down payment, plus another potentially $5,000 to $10,000 for the closing costs. Not many people have 25 grand laying around anymore, right? So we've solved that problem. We don't need the down payment. We'll do it with no money down for the down payment. Yes, you have your closing costs. The good news is these interest rates have been high for so long that sellers are willing to chip in and help out with closing costs. And that's where Celeste comes in, where she can work with the listing agent. I'll get on the phone, tell the listing agent where we're at with the financing, help them to feel comfortable. And then we'll try to negotiate to get those sellers to chip in and pay some of your closing costs so that you can get into a house and get out of that rent. So that's a really popular one that we're doing right now for our conventional buyers. So we're talking people who got really high credit scores. Maybe they, don't want to be in an FHA loan. Maybe the house needs a little bit of work that FHA isn't going to sign off on. We've got a 1% down program. Okay, you got to come up with 1% of the sales price to buy a house. Hopefully that's something that can be done. And I'll take it a step further. State of Illinois for a very long time has had the IHDA down payment assistance program. You can have household income of about 125, 130,000, and they'll actually give you up to $10,000, and that $10,000 can be used towards your down payment and or your closing costs. Oh, by the way, we can still ask the seller to chip in and help out with closing costs too. So it's entirely possible for people to still be able to get into a home without having 20% down, which is the biggest myth out there, that you need 20% to buy a house, and it's just not true.
So is there any IDA money out there right now?
Tons of money out there. Yep. Yeah,
Okay.
they're giving 10%, up to $10,000 to be used. So, if you're looking at, let's just say we can get you into a mortgage where you have the money for your 3.5% or your 3% down for a conventional loan. Well, we bring in the IDA with the $10,000. That's going to cover all of the closing costs on the transaction. You're not going to have to worry about that. You're just going to have to worry about whatever your down payment requirement is.
Are there other restrictions with regarding getting IDA money?
So it's mostly an income-based restriction. It's available in the entire state of Illinois. You don't have to be a first-time buyer or you can be a second, third, fourth. You can buy a 2-unit property. But the main restriction that you're going to see is they really do want you to have at least a 640 credit score in most cases. Sometimes we can get it to work at 620. And again, depending on the area that you're going to buy, maximum income is going to be about 125 to 135,000. Kind of depends on your household size.
Mm-hmm.
That's where I come in. Let's get on the phone. Let's go through a pre-qualification. Let's see what your credit report looks like through a soft credit check. It's not going to hurt your scores. Let's just check and see what we got. We're going to collect your documentation. We're not going to send you out looking at a house with a pre-approval letter if we haven't reviewed your paperwork and we know for sure that we're going to be able to get a deal for you. I can't send the buyer out to you, Celeste, and say, hey, take this person out. Good luck finding them a house. Let me know when you get under contract. That would be a complete waste of your time. That would be a complete waste of their time. Everybody that comes through here, we put them through underwriting so we know the deal's going to work. So you don't have to worry about going out shopping and in the back of your mind the whole time you're like, I really hope this down payment assistance is going to come through for me. No, we're going to make sure it's going to work for you ahead of time.
Is the IDA program geographically limited?
No, the entire state of Illinois is eligible for the IDA program.
Okay.
What's really cool about this too is it's also available to veterans and to USDA borrowers. So if any of our viewers are downstate, maybe they're a little bit out west, they're not super close to a metropolitan area, we'll plug in where you live. We'll look up the address of the homes that you're looking to buy, and we'll check to see if that property is eligible for USDA financing. And USDA financing, there's no money down again. That's when we put in the down payment assistance. Again, you're walking into a house without any money out of pocket. Got several people right now that we're doing this for today. And if you're a veteran, gosh, if you're a veteran, give me a call. Nobody gets a better mortgage than a veteran, that's for sure. Thank you for your service.
Veterans. Yeah. I have had my share and I can't help them enough. So
and that's just another source of tremendous pride that I get from being in this industry, because there are the VA loan that's available to the veteran to be able to give them that security of homeownership.
Mm-hmm.
It's pretty nice to be able to do that. And you talk to some of these men and women, and they've been through some really tough things, and they're out there doing that so that you and I can enjoy the comforts and live the way that we're able to live, which is unparalleled compared to the rest of the world.
I hear you. Is there anything else you want to share?
When it comes to stuff, I mean, that's kind of the key is we got to just start talking about your situation, but it's very likely that you're not going to need any money. If I can get you any sort of a loan, I can get you the FHA loan with no money down. So, don't let down payment be a barrier to you or anybody becoming a homeowner.
Very good. All right. So there is one other part of this section that we didn't talk about, which would be loans that are rehab loans.
Yeah. How often do you go into a house, Celeste, and you walk in and get blasted with the smell?
Yeah.
Or, you kind of get to see how other people live, and you're like, oh, gosh, that's just not going to work. Maybe our carpet's trashed. We need a bunch of paint. The deck is halfway fallen off the house, or it looks like the Brady Bunch just moved out, right? Maybe the house is fine, but it just really needs to be updated. Loan Depot, we are the largest and most successful rehab lender in the United States. We do more rehab loans than anybody. We do them better than anybody. It does not take me one day longer to close a rehab loan than it takes for me to close your typical standard run-of-the-mill mortgage. So let's just say you're out looking at houses, and let's face it, inventory's tight. We only got 2 months supply, I think it is, and we're well short of the healthy 6 month that we need. So people still need to sell their houses, and I will go and look on the websites, and I'll see these houses all the time. They're all over the Chicagoland area, everywhere. Is you've got a house where, hey, if it was really, really nice and it was all fixed up, it could sell for 50, 60, $70,000 more than it can right now. Well, here's the good news. You can get in there, you can buy the house. Celeste is going to negotiate. She's going to try to work the condition of the property against the seller as much as possible. And then we're going to close the loan for you. And we're actually going to give you money so that you can rehab that house and customize it so that it works best for you and your family. One of the amazing things about these rehab programs, the FHA 203K, for example, is you can go find a house that is just in horrible shape. Let's say it's a $50,000 house that just had a fire and it's completely uninhabitable, but nobody wants to buy it because it's $50,000, it's uninhabitable, and it just had a fire, right? The FHA 203K loan will allow you to completely level that house, carry away the old structure, and as long as you build a new house on the footprint, it doesn't have to be the same size, it doesn't have to fit exactly in the footprint of the slab or the foundation, it just has to be on that spot where it was at. You can make the house 10 times bigger if you need to. You can literally build a brand new house right on top of one of these houses that have been torn down. And the beauty of that is that you don't need to go through construction financing, which typically is much more stringent. They are looking for that 20% down payment. There's a lot more to it. Just get you an FHA loan, tear down the old house, build a brand new one. How about that? You got a brand new house in place of that dilapidated shack that was there. So that's one of the beauties about the 203K. You know, hey, if you're working with a seller, let's say you got a seller who's got decent amount of equity in the house and they'd like to get the house sold at some point, but you look in and you walk in there and you look at it and you say, guys, you're just not going to be competitive with the other people around here. We have to get some work done in this house. Well, there's things we can do with like home equity loans, personal loans, things like that, but we can also use a rehab loan to use some of the equity in that property to get the home fixed up and get it sparkling so that now when you go to list that house on the MLS, people look at it right away and they say, I want that one. It's completely brand new. It's another way you can use the rehab loans.
So what are the current limits on those two loans?
Yep. I'm sorry?
What are the current loan limits for 203K loans? What are the current loan limits?
So whatever the county maximum limit is that's a number that varies from county to county. That's definitely something that I'd like to talk over on a case by case person, because then we do have to start worrying about debt to income ratio problems. But we're talking well over 500,000 on those loan limits. And if we go with the conventional loan, now we're getting well over 700,000. And Loan Depot is one of the only lenders out there that will do a rehab loan for a veteran as well. So a veteran can buy a property, completely rehab it, no down payment. Once again, Celeste goes and negotiates with the seller to get some money towards the closing costs. So again, can't talk about this enough. If you're a veteran out there and you're watching, let's talk, because at the end of the day, we can get you into potentially without a dollar on it. You're going to have a little bit of money as far as an appraisal goes, but come on, you got to have at least $1,000 or $2,000 laying around to buy it.
So with that said, okay, how about this? What would you say if I'm somebody I'm wanting to buy, but my credit score is not great? And define what is not great.
So we all know that a great credit score is 740, 780 or better. I think that most people know that. I have seen people with 550 credit scores get approved. And when we go to evaluate somebody for a home loan, we're not simply evaluating just based off of the number. what's happening is that we're looking at the overall payment history. So you might have a 550 credit score right now, but also in the same breath, we can prove that you've made your car payment on time for the last 12 months, paid your credit cards on time for the last 12 months. Maybe you got a bunch of medical bills that your insurance company is giving you a hard time about, but they're showing up on your credit report as collections. Those are still going to bring your credit rating down. As a lender, we're going to look at that and say, no, you know what? The payments have been made on time. This person was able to pay their rent on time. The credit score is only low because of these medical bills, for example. That's a situation where we bring the loan in and we do it as a manual underwrite. So that means that my underwriting team, who are amazing, are going to literally open up the FHA book, and they're going to have your file right there, and they're going to go line by line through the FHA book to make sure that you qualify. Before I send the loan over to the underwriter, I'm going to at least give it a quick look over myself and my team to be sure that we aren't wasting the underwriter's time too. But ultimately, it's going to be a matter of just turning it in. Here's the thing is, if you've got good, stable job time, that's a good way that we can work around a lower credit score. If you've got money in reserves, hello, stock market's been doing awesome lately, right? Everybody's 401ks are growing like crazy. That helps. We take that into consideration. And then, of course, the down payment. Are you putting down the minimum, or do you got the funds together where you can put down 5, 10, 15, 20%? All of those things get looked at as compensating factors to help us out with issuing the approval. But it all starts with the soft credit check. We're going to do a soft credit check. All 3 credit bureaus, by the way. It's not going to hurt your scores. And as I'm reviewing your credit report with you, I'm also going to have on another screen, I'm going to have a simulator up and ready. And what we're going to do is I'm going to look through your credit report, and let's just say you got some credit cards that are a little bit higher than where you'd like them to be, right? It's about to be Christmas. That's going to be most of us, okay? So we talk on January 2nd. You haven't got the credit card bills in the mail yet. I will run that simulator, and it will tell me, hey, right now you got a 550 credit score, but let's pay off this credit card. Let's pay down that credit card. Maybe we dispute something. And then all of a sudden, it'll tell me exactly how long it'll take for your credit rating to come up. So a lot of times I'm looking at this and I'm saying to people, hey, I can't buy you a house right now, but go drop $600 on this credit card to pay off this little bill here. And then let's look at it again in 30 days, because the system is telling me that you're going to go from 550 up to 620 in 30 days. Everybody's situation is different. We'll take a lot of time reviewing that. And if we can't get the loan done now, myself and Celeste, we're going to make sure that we're keeping in touch with you, offering you that encouragement, and just being there to answer questions for you to help make it happen.
Okay.
The majority of people I talk to, if I'm being frank, is that most of the people I talk to that are closing on houses right now, I spoke to them 2, 3, 4, 5, 6 months ago. Some of them, it was a couple of years, because these things take time to fix. So don't be afraid to at least let us look at it, do the consultation. It's not going to cost you anything. At least now you can take some control, and you're going to have a plan to be able to buy a house if you're not ready right now.
So I'm going to ask you a question that's not on your list, but I'm asking because I have experienced this. When you have a buyer, they want to buy, but they're really, really shy on their own money. Where do you recommend people think about looking to get money?
To get money.
Mm-hmm.
Okay. Well,
what are some sources?
The first one we go to is a gift. Do you have a family member that can give you a gift? Okay, if you do, great. That's easy.
Is there a restriction on that gift?
No. You can have the entire down payment. All the closing costs can be from a gift. Now, it really needs to be from a blood relative or somebody with a closely defined relation. Okay. I've pulled up old Facebook of people before. I've pulled up wedding invitations. I've pulled up all kinds of things to be able to prove that close-knit family relationship. And we talk to our underwriters about it ahead of time. Hey, is this going to work? This is what we got going on. No, that's not going to work. Well, here's the good news. Why don't you take the money, open up a joint checking account with this person? Both of your names are on it. have that person put the money into the joint checking account and let's let it sit there for 30 to 60 days. Technically, that is your money now. That is no longer a gift.
Hmm.
In addition, sometimes when we put a gift into the loan application, that actually increases the layer of risk. So it makes it a little bit harder for FHA, Fannie Mae, Freddie Mac to approve the loan. So sometimes we have a workaround where we can say, hey, this money's been seasoned. It's technically their money. This time of year, we're all getting ready for our tax returns coming a few months. Now's a really good time to sit down and look at how much money you have taken out of your paycheck. If you got a nice tax return last year, maybe you're going to get a nice tax return this year. Let's start earmarking those funds right now so that we can use those in the spring for you. Another really common one, there's two of them actually. First, I'll talk about an IRA. So not giving any finance advice, anything regarding your IRA, you need to talk to your financial planner to verify this and your accountant. However, you can pull money out of an IRA. As long as you get that money back within 60 days, you don't have the tax penalty on it. So that's really good for our customers who maybe they're sitting in a house right now, and the only way they can come up with the down payment is if they sell the house, but yet they can't get their offer accepted on a new house because they got to sell their house. So everybody's stuck. We're in this gridlock. Well, if you have the resources, let's pull the money from your IRA, and let's just make sure that we get the funds back there in time. A little bit risky there, but sometimes we have to do these things to pull things off for people. People move because they want to move, but more times than not, I find that people move because they need to move. They're bursting at the seams in their house, job changes, all kinds of things. So again, we're going to talk it over, make the best decision. Most common one I see though, besides gifts, is going to be just leveraging people's 401k. Often when I'm talking with people about this, I'll say to them, look, you can cash in the 401k. Your employer will probably let you do that, but you're looking at anywhere from a 20 to 40% tax hit on that. That's a pretty big tax hit when you consider how long and how hard we have to work to build up that money in a 401k.
Mhm.
What I recommend is let's do down payment assistance. Let's get the seller to pay your closing costs. Let's use the money you have in your checking and savings. And then we're going to go to the 401k as sort of the backup plan. And when you do that, what I want you to do is see if you can actually take a loan against it, because you're going to take a loan at a super low interest rate. And most 401k plans, you actually end up paying back yourself the interest. Now, as you pay back that 401k loan, say you take out a $10,000 401k loan, and every month you have $200 going back towards the principal on it, that $200 immediately gets reinvested for you. So it's not like you have $10,000 that's just been completely taken out of the market. It slowly works its way back in so that you can continue to grow. And there's no tax implications for the 401k. So hopefully that helps.
Okay, that was good. Now here's another question we have from our sheet is, I want to move, but the problem is I need to sell my home first.
Yeah.
How can I work around this?
Yeah. This is one of the, in my opinion, this is one of the biggest reasons that we have such a lack of inventory right now is that, we've all been able to sit here and watch the values of our homes go up, 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 up. Well, that's real money that we own, but we can't get it unless we sell the asset, the house, unless we take out a loan against that equity. So one of the options that we have here is we can actually do a home equity line of credit. This is the easiest one. We completely leave your first mortgage alone. You can keep your 3%, 2%, 4%, whatever you got on it. But then we could use a home equity loan to pull that additional equity that's just sitting there and not doing anything for you. So we fund the home equity loan, and you can immediately make sure that that money gets wired to the title company for the closing on your new house. Now we can use that money not only to cover the down payment and the closing costs, but we can also pay off debt. Well, a lot of people will say, well, Josh, I'm nervous about having potentially 3 mortgage payments, and I don't blame you. I don't. But if your trusted realtor is telling you that there's a good chance that your house is going to sell quickly once you get out of it, you got all your pictures gone and all your furniture, she's probably right. She knows what she's talking about. She should be able to show you evidence of other homes in your area that have been on the market and how long they've sat so that you can make an educated decision. So you list your house today. I'm sorry. We give you the home equity loan today. The money for your down payment is right there. The next day you turn around and you put your house on the market. The following week, we close on your new house. Your first mortgage payment, if we were closing on a new house for you today, you wouldn't have a mortgage payment due until January 1st. And technically you do have 30 days to make it before you're late. Pay it on the 1st. If we close, say, beginning of December, you don't have a mortgage payment due until February 1st. So there's a little bit of a break from the time that you close on the new house until your first payment's due. Maybe that gives you enough time to get the old house sold so that you don't have to worry about making 3 payments: mortgage, home equity loan, new mortgage. The other thing that we do more times than not is we say, all right, we got this home equity loan. Why don't we do this so that we can give you 5% of the sales price? So you're going to put, a very low amount down to start. Let's use the rest of the equity in the house to wipe out all of your debt. That way, if we do have a situation where you do have these additional payments, at least you don't have those credit cards that have been driving you nuts for years. You don't have the car payment. Oh, and guess what? We could probably also use the loan, maybe give you back, like, say, 6 months worth of mortgage payments on the old house. You could take that money and you can stick it in the bank and forget about it. And that's the money that you can use to pay your old mortgage until you sell your house. Really great strategy. It takes time, and we talk it through, and
It takes a plan.
Takes a plan.
And
Sure
we've had this conversation where, as a realtor, when I have clients that are interested and they want to buy, but they have a home they have to sell, and how do I bridge this? Because I can't afford to buy anything unless I know that I like the house, but I still have a house that I have to sell. When we talk about any of this, I always say, and I know you've heard me say this, don't do anything. Don't list your home. Don't put a sign in the yard unless we have this conversation. What is our plan? You have to have a plan.
Yeah.
And frustrating thing is to watch someone say they're going to refinance their home to pull money out, but they've already got a great rate. And if they refinance, all they're doing is exchanging it for a much higher interest rate when they didn't have to.
And
They could have done a home equity line of credit.
Yeah, what happens if you can't buy a house, right? Job changes, someone gets sick, there's all kinds of things can happen. So that's why the home equity line of credit is a great option, because it's just a massive credit card that is backed by your home. So how much do you owe on your credit card if you don't use it? Nothing. You don't pay interest, you don't have a payment. That's exactly how it works with a home equity line of credit. So you can literally take it out and just sit on it until you actually need it.
Yep. It's a great idea. It's a fabulous idea.
Very popular.
When I talk to people, often they'll say, well, what if I buy a rental property? What's involved in getting a rental property?
Absolutely. There's a ton of this going on right now. So, excuse me, a lot of people, the majority of us are sitting in mortgages at 2, 3, 4%, like I said. And we're looking at our situation and we're saying, you know what? I could use more room. Yeah, maybe I'd like a little bit of a nicer house, but I don't want to give up this amazing interest rate that I have on this property. Great. You don't have to. Yeah, but Josh, I also don't want to buy an investment property either, because the interest rates are higher on investment properties than they are on primary residences. Yes, they absolutely are. There's more risk. if you're in a position to where you can't make your payments anymore and you had to pick, you're going to pick the house that you and your family live in before the house that your tenants live in, right? So naturally, lenders are going to say, we're going to price this out accordingly. You're going to pay a higher interest rate. It's kind of like if you're driving a Ferrari, you're going to pay more for insurance than you are for a Toyota Corolla, right? So in response, what we have seen over the last 4 or 5 years now is that there has been a big resurgence in what we call private money, hard money, non-QM mortgages. So you can still buy an investment property using a conventional mortgage. So by conventional, I mean loans that are insured by Fannie Mae, Freddie Mac.
20% down?
20% down. It's also going to show up on your credit report. You're not going to be able to title that property in the name of an LLC. The LLC provides you tax benefits and it provides you some legal protection. Again, talk to your accountant, talk to your attorney. An LLC may not be right for everybody, but it's really common. So enters what we call the DSCR mortgage, debt service coverage ratio. The way this mortgage works is that you're going to still need your 20 to 25% down. That doesn't change. By the way, we can use your home equity line of credit to get you the 25% down too. Okay. Don't have to touch your 2, 3, 4%. So anyway, so we get you the money so that you can do your 20 to 25% down on the rental. What's going to happen with that is that we're not going to have to review your tax returns. We're not going to look at your pay stubs or your W-2s. The only income that is going to be considered on this type of loan is the rental income that the property brings. So, for example, say you find something that's going to be a $1,500 mortgage payment with property taxes and insurance. As long as the rental income for that property, as dictated by the appraiser, is $1,500 or more, you're good. That's the only income that we have to look at in order to be able to get this loan done. It's also one of the beauties is you can close in the name of your LLC. So now you go, you file your tax returns with your accountant, you got your LLC going, you're writing off as a ton of interest, the expenses, the insurance. Basically, every dollar you spend on this property is potentially a write-off for you. The interest rates on these programs are very, very similar to a conventional mortgage. Sometimes they actually end up being a little bit better because conventional mortgages are tied to the 10-year treasury, whereas these mortgages typically follow the 2-year treasury. And depending on the day of the week, one might be doing a little bit better than the other. So you don't be afraid of the interest rate. The key is it's got a cash flow for you. The beauty is that you're able to keep that loan off of your personal credit report. So now, if we get into a situation where you're going out to get a car or you want to buy a new primary residence, I don't have to look at your credit report and say, well, you got this mortgage and you got a bunch of other mortgages that are being counted against you. The most common thing I hear from a new customer is, yeah, well, they're all rented out. And I say, yeah, let's see your tax returns. And your tax return has done such a good job for you of writing everything off that it doesn't look like you make any money on these rental properties. Now I'm in a situation where I can't get any sort of conventional FHA financing done for you because you got all these rental properties in your name. So that's where the DSCR comes in. It keeps that off of your personal credit report, and it makes it a little bit easier for you to keep your personal finances and your business finances separate.
Interesting. And just for the sake of asking, if you needed to hire, say, a company that does management, is that not a business write-off?
It's too.
It's a cost of doing business.
Yes, right. I mean, I have customers who, for instance, I have a client that he's up here in the Illinois area. Last summer, he bought 2 properties in Florida, and he's renting those out. And my investor said, well, wait a second, this doesn't quite make sense. You're in Illinois. These are in Florida. And he explained that, hey, I also do business in Florida. The majority of my time is up here in Illinois, but I'm going to protect my investment. So he did. He got hooked up with a property management company that went through and He doesn't do anything now. He just sits back and cashes the checks. His property manager handles everything. Whenever he needs to get a new tenant in, the property manager does anything. It really has become a set it and forget it business.
Yeah, it's a great way to go.
Some investors want to be more involved with their tenants and the properties, others don't. It's just kind of a personal preference, and it's all about the numbers.
Okay, sounds good. Are there any other questions that I should be asking you?
Just going on the lines of for investors, a really popular product is fix and flip financing. So I'll tell you, let's just say let's say you're a property investor, Celeste, and you see a property that is selling for $100,000 and it's in really bad shape, right? Okay. And you're a brand new investor. You're going to need 30% down on that 100,000. Well, let's just say that you've flipped or acquired 5 rental properties in the last 3 years. I can actually get you financing on that property with only 10% down. We're going to get you an investment property that you're not going to live in, 10% down in the name of your LLC. It's not showing up on your credit report.
Why is that?
Because everything is a business purpose loan. We don't do any income verification. It's very little income documentation. The loan is technically being made to the LLC, whereas you, the buyer, are giving a personal guarantee on it, but it's not going to show up on your credit report. So
You know what this tells me? I think this is one thing that I hope others are hearing, that you don't know what you can or cannot do until you talk to a lender. No matter what your situation is, no matter what your opinion is about your status, it may not be real. It may not be current. And so making assumptions that you can or cannot do alone, it's almost like I just want to say, stop. You're not the lender. The lender has programs and financing type programs. I don't know what else to add, but
yeah,
you have a variety of things to offer.
exactly. It's sort of like I use this analogy a lot when I'm talking to someone is if I came to you and I handed you a puzzle that was in a box, 1,000 pieces, we'll say, 500, doesn't matter. But I hand it to you with the box and you at least have the picture on the box, you're going to be able to put that puzzle together, right?
Mm-hmm.
Lending, what happens is it's like you're getting a puzzle at a garage sale and it's in a Ziploc bag. So it's like, Josh, here's my puzzle. Here's all my pieces in this Ziploc bag. And then what I have to do is sit down there and I have to take all those pieces and figure it out. And I have to say, okay, what's the closest thing that we can get for this person? Well, I'm not going to be able to do it exact potentially because I might be missing a piece or two. But I know that if I can at least get it put together in a certain way, I probably got enough to where I can go finish the puzzle up for
Yeah.
them. And that happens.
Do you make your own puzzle pieces?
What's that?
So do you make your own puzzle pieces?
No, we don't do that because if we made our own puzzle pieces, that would be considered fraud. So we try to just work with the pieces that we have.
Okay.
But I
Sounds
wanted
good.
to finish up one point on that fix and flip thing. So if you're an experienced investor, you can buy it with 10% down. Doesn't matter how bad the property is we will literally give you money so that you can go and rehab the property and get it completely fixed up. And now once it's all fixed up, you can make a decision. Do you want to sell it for a profit? Call Celeste if you do. Or do you want to cash out on the new equity, pull more equity out of the property and rent it out and use that equity to go buy another one? We have made so much money for people doing this.
One thing I heard you just say that I realized we didn't clarify is the work needs to be done by a hired contractor that is vetted through the rehab program. Am I right?
Correct and not correct. So if we're doing like a 203K, a conventional Fannie Mae home style Freddie Choice or the VA renovation, depending on the level of work, we may have to go through and vet the contractor. And when we do that, we're just making sure they got their insurance, they got all the stuff that, we're making sure you didn't find a bunch of guys at Home Depot and saying, get in the truck, let's fix this house, right? We want to make sure
Okay.
that know what they're doing and have some experience. That's a protection for everybody, including the
Mhm.
homeowner. But when it comes to the investors, no, we don't have to go through a contractor vetting process on that. What I have is a lot of my guys who are professional real estate investors. They've got 5 plumbers, 5 electricians. They just got their roster of their guys that they know are going to do a good job, and they just have them in and get it done. And we've got them. Some of them are running 3, 4, 5 projects at a time.
Wow, that's
Yep.
excellent.
They're making a ton of money. Yep.
Well, I want to say thank you for joining me tonight. I think this was really, really beneficial. And for anyone that's watching, I'm just going to suggest one more time that if you're looking to have 2025 be the year that you buy a home, this is the best time that you could be talking to us. Don't wait until 2025. Call us. Josh's information is in the description, and so is mine. And I also know that the quality of the people that you work with is going to be a reflection of the quality of your experience. So if you're focused on, somebody because they're at church with you, or someone because somebody that said, hey, I got a guy. Keep in mind, not everyone is coming to the table with the same background and experience and exposure to different programs as Josh and I are. He's the guy that does the financing, and I'm the person that does the house process. Everyone knows what their job is. We stay in our own lanes because we know we can rely on the other one. So with that said, thank you again, Josh. I really appreciate your being here. And I am Celeste Barr with eXp Realty, and you are welcome to Google me, and all of my information is out there. We just want to welcome you. The call to action for you is to either pick up the phone or text us or email us. Any of the above would be fine. Reference this video if you could, and just know that we are here to help you. This is our purpose in this whole business, is to be a support and guide you through this process. All right. Well, thank you.
Partner Loan Depot. I'm on Google myself.
All right. And stay tuned for our next video that will come up next week. Thank you.
Thanks a lot.
Have a good one.
Bye.
Bye.